Hey traders, Gavin McMaster here from Options Trading IQ, and I just wanted to go through a couple of this week's trade ideas from the Accelerator program. If you're not part of the Accelerator program, the next opening will be probably around late May, early June. Just before we get into the ideas, quick reminder that everything discussed is for educational purposes only, is general in nature and does not take into account your personal circumstances. So the first one was a bear call spread on AVGO, and the signal for this setup was yesterday's candle where it broke below the 200-day moving average, and it was testing this support level on the prior low, and it looked like it was going to break down below that level. I used my bar chart scanners to find this idea. So this was one that came up on a scanner that I run for stocks that are breaking either above or below the 200-day moving average. So for the initial setup, we sold the 200 call and bought the 205 call using two contracts. That gives us about 900 at risk, and we received about $100 in premium. And with the move down today, we can see that the trade's already in profit to the tune of about $50, and we might be able to close this out nice and early for a very early profit. So that one's going well so far. The next one was a longer term wheel trade on BMY. So that was another stock. This one came up on my scanner for stocks that were close to a 52-week high, so within 5% of a 52-week high. I run that scan via FinViz, and then I just come in here into stock charts and look at the chart, and I can see that it was holding above that rising 50-day moving average. It was above the rising 200-day moving average, so one of the stronger stocks in the market. And we're seeing quite a lot of accumulation in the last month here. This indicator that I'm using is the accumulation distribution indicator. If this is going upwards, it indicates that money's flowing into the stock. So a lot of positive underlying breadth or momentum in this name, and it's pulling back nicely here to the 50-day moving average. So what we looked at was selling it out of the money put. We were tossing up between two strikes, the 52.50 strike or the 55 strike. What I usually do is I have a little spreadsheet. If you don't have a copy of this, I'll post a link in the description. We pop in the stock price, the strike price, and the premium, 48, and kind of looking at these two numbers, and I want to find something that I'm happy with. Now, this one here, because it's quite far out of the money, it's giving us a really big decrease to our break-even price, so a really big margin for error. The stock can decline 13.5% before we lose money at expiration, that is. And it's providing about a 9% annualized return, which isn't massive, but for a low beta stock like this, it's pretty good. And with the market being quite volatile, I'm really looking for defensive stocks to be trading at the moment rather than some of those high risk growth stocks that have really been under a lot of pressure. Then we compare it to the other strike at 55, which was a little bit closer in. Slightly lower decrease to our break even, but a slightly higher annualized return. So either one of those is okay, depending on whether you want to go for the higher return and slightly lower decrease to break even, or if you're willing to accept a slightly lower return and have more margin for error. So we ended up going with this one, being quite conservative and trading that quite far out of the money. If the stock drops below 52.50 at expiry, we'll get assigned, we'll collect the dividends, we'll sell covered calls against it. We may potentially sell some more puts as well and dollar cost average in on the downside. The next trade was a bear put spread, so a debit spread on the semiconductor index SMH. I chose this one because a lot of the semis were breaking down, NVIDIA, AVGO, etc. Normally I would be an option seller, and it would be quite rare for me to do a debit spread like this. But I wanted to have something that had limited risk and a good reward. So we've got a really nice reward to risk ratio. Whereas if we think about that AVGO credit spread, the reward to risk ratio was the other way around. We were receiving 100, risking 900. Here we're risking 300 to potentially make 1200. So the reason for doing a debit spread here is I wanted to lose only a little bit if I'm wrong. So if this ETF starts to rally again, I'm only going to lose a little bit rather than potentially losing a lot with a credit spread. The downside, of course, is we're losing money each day through time decay or theta. But the trade will do really well if the ETF continues dropping, and obviously we're going to lose money if it rallies. Usually for a debit spread like this, I'll set a stop loss of 50% of the premium paid. So in this case, we're paying $300. If the ETF rallies and we're sitting on a loss of about 150, I'll just close it out. I won't do any adjustments. That's kind of my stop loss point on this one. And the final idea was a fairly high risk trade on the assumption that the market might continue lower. What I did was I looked at the chart of the Qs. We hit resistance here at the 200. We're below a declining 50. We're now below a declining 21-day moving average. And I was thinking we might come down and retest these lows and perhaps go a little bit further. And I came up with a price target of about 450. So what I've done then is I've centered a butterfly right at that 450 strike. I'm using the puts because I want everything to be out of the money. I don't want to have these short puts being in the money. If I used calls, they would be in the money and subject to assignment risk, albeit very low risk. But if I'm doing a bearish butterfly like this, I'll always use puts. So centering it at 450, $50 wide results in risk of about 1,200. Its trade's already up a little bit. Again, it's a debit to enter the trade, but in this case, we do have positive theta, which is good. But I'm going to set a 50% stop loss as well. So risking about 1,200, stop loss of about $600. And you can see it's quite directional. With this T+0 line, we're going to make some really good money if the stock or ETF continues downwards, and we're going to lose money if the ETF continues upwards. Now, this is partially a hedge for some of my long-term bullish positions as well. We've got a lot of negative delta dollars here. It could be a standalone trade. If you are negative on the markets and on the Qs, that's totally fine. This is a little bit of a hedge trade as well for me. So you can see if we head down to that 440, 450 level, we're potentially going to make about $1,000 over 1,200 at risk. So really nice return potential. And as I said, stop loss of $600. If you wanted to do this with a little bit less risk, and this is something we talked about in the accelerator webinar yesterday, our weekly webinar, we could just trade it a bit more narrow, and we'll go 25 points wide instead of 50 points wide. And I'll show you the difference, which might be a better option for some people with wanting to risk less capital on a trade like this. So here we're keeping our center point the same, but we're doing 25 points wide now. And you can see much, much lower risk in the trade, but we're going to make a lot less if the ETF goes down as well, but only risking in this case about $300. So that's a potential. It's also much lower delta dollars. So you would structure it depending on, how much negative delta you wanted, how much capital you were willing to risk, etc. The other difference here is our structure is not quite as wide as the previous one. So that's a little alternative scenario that we talked about. All right, if you've got any questions on any of those trades, feel free to leave a comment below or shoot me an email, info@optionstradingiq.com. I hope that helps you. Have a great rest of the week and reach out anytime with questions.